So the wait is officially over after roughly 2 years of higher interest rates. The Fed's decision yesterday was to take the bolder route and reduce the benchmark rate by 50 basis points, 0.5%, as opposed to 25 basis points or 0.25%, which had been kind of assumed for the previous, call it, I don't know, 6 months, I guess. But within the last week or so, maybe a couple weeks, the consensus had kind of started to shift to a more aggressive outlook. It was starting to become more assumed by traders and institutional players that, the Fed would go more aggressive with 50 basis points, which is exactly what they did. So obviously there's a lot kind of to unpack here. I thought I'd just put this video together. I'm not going to spend a ton of time on this. I'll probably do a more in-depth blog on this as more things come out. But just real quick to kind of give you an overview of where we are and what this might mean in the near future. I figured I'd put this video together. Again, this is if it seems unorganized, it's because it is unorganized, and I threw it together last minute. But basically, what we're dealing with here is the Fed doing exactly what it's supposed to do, which is impose its dual mandate. So the Fed, at the end of the day, has this what they call the dual mandate. Its two primary functions are to promote stable prices, to obviously control inflation, which it has now done a pretty good job of as it gets closer and closer to that 2% inflation target. So over the last couple of years, we've made a ton of progress on that without sinking the economy, which is huge. So economic growth has remained still really resilient, and even employment has remained fairly strong. But lately, as inflation has come down closer to that target, you have started to see some cracks in the economy, a slowdown to an extent, and also employment numbers, although still very strong. I wouldn't say they've just dropped. It's just that kind of hiring is somewhat plateaued. And so what's happening now is the Fed is kind of shifting the narrative from got to bring down inflation to, hey, kind of got that under control to an extent. We feel good about it. Now let's focus on the other side of the dual mandate, which is maximum employment. So in order to do that, you've got to have a stronger economy, right? I mean, the two kind of go hand in hand. So to promote maximum employment, you kind of have to have the economic growth in check. And so that's exactly what we're experiencing now with this 50 basis point reduction in rates. So that will probably be the narrative going forward, is promoting stronger economic growth and trying to prop up the labor market. And so with these interest rate cuts, there's interest rates are a powerful force in the financial system. But just in general, we can kind of look at this bulleted list. These rate cuts mean a few things. Obviously easier monetary policy, just easier money supply, obviously, as rates come down. It does tend to be good for the economy, just in general, as easier access to capital. Obviously corporations have an appetite for capital, and so this leads to the ability to access that easier, especially for smaller capitalization companies. As we've seen, small cap stocks have really taken off here lately in anticipation of lower rates, as we've talked about many times. And this does tend to lead to a stronger labor market, because as the economy heats up and begins to do better, obviously companies in turn should benefit from that, and hopefully hiring picks up. So it does tend to be good for stocks as well. We can talk a little bit about that too. In fact, I'll just got to bring up a couple of cool charts here. So this is something that's always been pretty interesting. So, and I'm using obviously the internet here, and I'm again, this is kind of thrown together, but this is via Morningstar and Ned Davis Research and all that. I'll put it in the disclosures, but stocks and rate cuts. So this is looking at, and this is going back 50 years, 1974, and oh man, I was born in 1976. That puts me a couple years away from 50. Wow. Well, it's a new 40, right? That's what they say anyway. So stocks and rate cuts. So going back to 1974, if we just look at what occurred after these rate cut cycles, more often than not, even within the first 3 months, stocks were positive. Now, not always, obviously. There are some periods where obviously that did not occur, primarily when we were in a recessionary environment. We'll talk more about that. But you can see that starts to really become more apparent in the 6-month period, in the 1-year period, in the 3-year period, and in the 5-year period. We look at the forward returns post these rate cut periods. So the average returns after 3 months, 6 months, 1 year, 3 year, 5 year were positive. The percentage of time we were positive in those various periods was 70% over 3 months, 70% over 6 months, 80% over 1 year, 80% over 3 years, and 100% over a 5-year period. Even in the midst of some of these periods experiencing some pretty bad drawdowns via a recessionary environment. So again, there's no guarantees on any of this. It could be down, in 3 months from now, 6 months from now, of course. But history shows that generally speaking, rate cuts are good for stocks going forward. This even it becomes more pronounced when you take into environments where there is no recession. So this is looking at that same data set going back to 1974, but it's just looking at the periods where there was no recession. So again, what makes this somewhat, unique, not, I guess I can't call it unique, but somewhat different, is that we have not thus far experienced a recession. Now that could change, obviously, but so far we have not experienced a recession. So when you're in that type of environment, if you look back at that same period, which these were periods where there was no recession, you had 100% of the time positive returns in all periods, 3 months, 6 months, 1 year, 3 year, 5 year, in which stocks were positive. So over all time frames, stocks were positive given the no recession environment or starting point. So again, all this is subject to change. This is no guarantee on anything. Past returns, we know, don't indicate future performance. We understand that. But it is helpful to keep things in perspective and just to look at historically what has occurred. So overall, rate cuts tend to be a good thing for stocks, and especially in a period where there is no recession. So take that for what it is, but that historically has been the case. Does tend to be good for borrowers, obviously, interest rate cuts. It's good for bonds. This is primarily through price appreciation, as we know that stock prices move inversely to interest rates. So as rates come down, bond prices tend to go up. It's just simple bond math. So it does tend to be better for a bond portfolio, and could help with the housing market as mortgage rates come down. That's a tricky one sometimes, and I'm no real estate expert, but just looking at it historically, yes, mortgage rates start to come down, but on the flip side, what you tend to see is prices starting to adjust upwards to compensate for the lower mortgage rates. So there's always a period where things get a little disjointed, but generally speaking, markets just adjust. So it could be better, especially for first-time home buyers. But I would also say that the housing market has a way of working things out, and so prices will probably go up on homes as well. So that's kind of it in a nutshell in terms of the kind of interest rate environment that we are now entering into. I would say that just generally speaking, the Fed is, it's reduced it by 50 basis points. So that's now down to 4.75, between 4.75% and 5%, the benchmark rate. This is down from 5.25% to 5.5% previously. It's expected that the Fed will probably reduce rates by another 50 basis points over the next couple of meetings through the remainder of the year. So it's likely we'll see another 0.5% reduction before the end of the year. That's always subject to change, but that tends to be where the consensus is now. We can also see that there's a pretty dramatic reduction projection over the next year. So you can see now that the Fed is targeting, this is the dot plot. So this is kind of all the FOMC members and their projections. And then you have this lighter dot that is actually the median. So kind of the average consensus here. So obviously by the time we get to the end of 2025, rates should have come down, quite a bit further. So right in that 3.5, call it, range, maybe a little less, 3.25 to 3.5% by the end of 25, and then on down from there. And you can see kind of longer run trying to get to that more normalized level of rates. So we are on track in terms of what the Fed has laid out, and I think this has overall been love them or hate them, I think this is shaping up to be so far a Fed success story as opposed to just a disaster. They have managed so far to get us to this point without sinking the economy and really just moving backwards in terms of economic growth to a significant degree anyway. So right now we're in this process of more of a soft landing as opposed to a recession, a hard landing, as a recession, or even worse, depression or something like that. So clearly there are no real signs that we are heading towards that. Again, as with anything in the markets and the economy, things can change quickly, but so far that's been the case. So I would say just in general, I feel pretty good about where things are. I will be putting out more information on this in probably the next week or so to come as we get more data and news around this. But just in general, that's kind of where we are. So, again, Fed, following through on its two mandates here. We saw a pretty aggressive cut yesterday, which I think over the last week had been kind of more expected. But just in general, I think we're in a good spot. And, time will tell. But, it's an election year, very contentious. Obviously, political climate is pretty bad right now. All those things, obviously I understand that it causes nervousness in the markets and probably nervousness for you as an investor. But just keep in mind that those things tend to be very temporary in nature. Their impacts over the long term in the market tend to be very minimal. And even this is big a deal as it is to start reducing rates because it's such a powerful force. When you look back over long periods of time, it tends to be just noise. It just doesn't matter that much broaden out the time frame. So whether or not they had, dropped it by 0.25% or 50 basis points, I mean, sure, in the short term, it can jar things, it can drive things a little bit, but man, it's not going to matter a hill of beans whether that was 0.25 or 0.5 reduction over the next 20 years. It just won't. But it is always good to understand the environment we're in and where we may be going. As always, we will keep you informed as best we can. Sorry for the little kind of disjointed presentation here, but just wanted to get that out here. So guys, if any questions come up, please let me know. In the meantime, we'll continue to put out articles and information around this. Thanks, guys. Hope you guys have a great weekend, and we'll talk to you soon.